Did you ever watch Mr. Rogers' Neighborhood? Of course you did. You either watched it growing up as a kid like I did, or you watched it with your kids as they were growing up. And I want to start today's video off with a quote from Fred Rogers. He would say, "Often when you think you're coming to the end of something, it's really just the beginning of something else." And what I want to talk about in this video today is the end of something that's been about 36 years in the making, and that's the growth in the bond market. So this is kind of the end of an era, and I want to explain a little bit what bonds are, how the bond market works, and kind of give you an idea of where things may be headed. If this is the end of something, let's talk a little bit about what the beginning of that next thing might be. But let me kind of go all the way back to the beginning. There are stock markets and there are bond markets. And the stock market is a very large market. It's worth about $30 trillion, but the bond market is much larger. It's worth today around $50 trillion. So it's huge. And it's made up of a lot of different things. Some of you may not be familiar with what a bond is, so let's also define that. A stock, in comparison, is where you invest money with a company and you own a piece of that company. So it's an ownership type of investment. But a bond is where it's basically like an IOU. It's a loan to a company or to the government or to a local municipality. And basically that's an IOU that says that they will pay you back that money at some point in the future. So you have ownership investments in stocks and other things that have equity, and then you have loanership investments that are really more in a savings category, and that's where bonds fall. Well, in addition to the different types of issuers for bonds, whether it be governments or corporations or municipalities or things like that, you have different credit qualities based on the credit worthiness of that particular issue. So a rating is a factor in this. You can have all the way up to a AAA rated bond, and those are the same ratings that insured bonds get. So they're the safest ones out there. The government has a AAA rating. Currently, they lost it for a while, but they've got it back. And insured bonds have a AAA rating. You can go all the way down the scale to a D-rated bond. And when you get down in that side of things, they're usually referred to as junk bonds. For the most part, you want to stay away from those. They have to pay high yields, but they can be very volatile and very risky. So you have different issuers, and then you have ratings. There are also maturities. Some bonds are only 30 days. You only have a 1-month bond. And some bonds extend all the way out to 30 and 40 years, and sometimes even longer. So depending on the maturity of the bond, usually the longer the bond, the higher the interest rate has to be, because you're tying that money up for a longer period of time compared to just tying it up for a short amount of time. There's more risk involved. There's more opportunity cost involved. So the longer the maturity, typically the higher we see the rates. And that arc that you see from short-term maturities and lower rates to longer-term maturities and higher rates, that's called the yield curve. So normally, over time, you see that yield curve rise to accommodate for that extra measure of time. So now we have the maturities, we have the ratings, and we have the issuers. The other important thing about bonds is the price. Most bonds are issued at $1,000 per bond. And so you pay that when you first purchase them, when they first come out, and then when they mature at whatever future date, they come due at $1,000 there. But what happens in the meantime? That's what's really bringing us to this conversation here about what's going on in the bond market. Bonds can trade for more money or less money than they're worth along the way. And it has a lot to do with where interest rates are. You see, when interest rates go up, bond prices tend to go down, and vice versa. When rates go the other way, the price moves accordingly. So we're in a situation right now where we're beginning to see rates rise again. And we haven't seen that in quite a while. So for 36 years, we've had a period of time where rates have actually been going down. And as a result of that, bond prices have been going up. But now we're beginning to see that turn around. And that era that generated those kind of returns looks like it's come to an end. But depending on the maturity of how long you still have in that particular bond, that will determine how much fluctuation you could possibly see in price. So the shorter the maturity, the less time it has to move around, and it's still going to come due at the $1,000 per bond. But if you still have 5 or 10 or 20 years left on those bonds, well, they could move a lot in price. Let me show you an example. In this particular example here, we have a bond that was an 8.75% bond. And you can see that from the time that it was issued until years beyond that, as rates began to decline, the price of that bond went up and down and up and down. But for the most part, it was up substantially. Even at one point there, you can see that it was up 50% over what its original price was. However, as the maturity got closer, that bond began to fall fast and started moving back to the $1,000 per bond, because that's the price at which it's going to be due, or going to come due. So now that we've had this movement in the bond market for so long, it doesn't look like there's going to be any ability to see those prices of bonds go up. In fact, if you're purchasing bonds today, then the prices of those bonds are likely to do the opposite of that example and be worth less than what you purchased them for all along the way until they mature. So that's an inverse relationship that we really haven't seen in a very, very long time. And most people who've only invested in the last 10 or 20 years, they've never seen it. But it's going to create a fundamental shift in the way that financial markets are managed, at least for the foreseeable future. There are certain industries or institutions that have to own bonds, like certain pension funds, certain insurance companies, things like that. They have to have a certain percentage in bonds. And for those types of investors, if we can call them that, they're going to want to keep those maturities really, really short. The other factor in all of this is the yield curve that I talked about earlier. Normally, the longer out you go, the higher the rate is. But because the Fed has been increasing rates lately, they control the short end of the yield curve. And those rates have been rising, but the long-term rates have not been rising at an equal rate. And so what you're finding right now is a very flat yield curve. So usually one of two things happens there. The short end goes back down, and we don't really see that happening in the foreseeable future, or the long end goes up. And that's likely what we're going to see. So any longer term bonds that are out there are likely to get hit very hard from a price standpoint. And although you would still be able to collect the interest from those bonds, the value of those bonds could be worth substantially less. Just like in the example where it was a 50% premium at one point, it's possible to see a 50% discount on some of those bonds along the way, even bonds that have very high credit qualities. So if you're looking at the yield curve, the difference between a 1-year rate of return and a 30-year rate of return right now is a little bit less than 1%. So why would you tie your money up for 30 years if you're not really compensated for it? But some people have to, and some institutions have to. So I think we're going to see that yield curve normalize and those longer term rates continue to go up, but that's going to put a lot of pressure on bond prices. So here are the lessons that I want you to take away from this video. Bonds have traditionally been considered a safe investment, and people tend to get nervous about the stock market and they transfer their money out and they run over into the bond market. Well, given this relationship between price and interest rates and rates rising, this may not be a safe place to be at the current time, especially if you go farther out on the yield curve with those longer maturities. So just understand that there is risk associated with bonds and be aware of that with any allocation decisions that you make. If you do have to have bonds for whatever reason, and naturally there's going to be some bonds in most people's portfolios, keep those maturities very short and keep the credit qualities very high. That'll help limit some of the volatility. The other thing is, if you have individual bonds that maybe you've had for a while and they're at a higher interest rate, you have a couple of options. One is you could go ahead and sell those bonds for a premium and take the profit on that, but you would lose the interest rate on that because you wouldn't be able to reinvest that back at that rate today. But maybe you would want to diversify that into something else. Or you could simply stay put, continue to collect the interest off of that, and have it come due at the $1,000 a bond whenever the maturity date comes along. So bonds are not necessarily a bad thing. It's not a bad time necessarily to have bonds. You just have to be careful how you incorporate those into your overall mix. And if you don't have to have bonds, there are other strategies and other solutions where you can still provide safety, get higher rates of return, offer some guarantees, some things like that add safety and return to really complement and mitigate some of the risk on the stock side. So let me go back with something here with Mr. Rogers. He always used to end his broadcast by saying, "I'll be back when the day is new and I'll have more ideas for you. You'll have things you'll want to talk about and I will too." If you have things you'd like to talk about, just leave them in the comments below this, and I'll be sure and take a look at those. And I appreciate the comments that you've left so far and the feedback from some of the other videos. I'm glad you're enjoying these. I have a lot of things prepared for you here, and I'm looking forward to sharing them with you. I'm enjoying creating these for you as well. So until next time, when I do talk a little bit more about really the beginning of what we're seeing come to pass with the end of this era, I'll unpack that a little bit more in another video. But for the meantime, be a good neighbor, and I'll see you in the next video.